Shopify just released their latest earnings report. Stock is down, as you could see by the thumbnail, and as you can see right here, 17%. And what has actually happened? Because this quarter was quite a strong one, so you would have guessed it. One, the stock was already quite expensive, and two, some issues with guidance. Now, before they reported earnings, they had a market cap of close to $100 billion, right? Forward PE, 74.9 times. Definitely not the cheapest out there, even though the analyst estimates look quite nice. Sales growth of over 20% for fiscal year 24, 25, and 26. EPS growth for fiscal year 2024, 40.9% year over year, then another 30+% growth in the next 2 fiscal years. So that's great. But as always, we know there is a right price to pay for everything. This is just a good business that has just run up too fast, even though this year it is flat and year over year the stock is up 24%. Sometimes, yes, valuations do matter. I'll start off here with a couple of comments. You're seeing the strongest version of Shopify in our history. Our outstanding Q1 performance is clear proof of our dedication to the new shape of Shopify, our commitment to operating with a consistent team size, and our focus on building for the long term to deliver both growth and profitability. We are building a 100-year company, and we will continue to remain fiercely agile, capitalizing on every opportunity that accelerates the success of our merchants, enables us to continue to build world-class products, and enhances operational efficiency for better returns. Shopify had a strong start of the year, building on the performance of 2023, delivering year-over-year revenue growth for the quarter of 23% or 29% when adjusted for the sale of our logistics business, combined with 12% free cash flow margin. I've been saying in the past, free cash flow margin, especially for Shopify, but for plenty of other businesses as well, is a very important metric to follow, sometimes even better than just looking at a PE or earnings or whatnot. Of course, in the long run, you have to focus on that. But as we've seen with the likes of, for example, Amazon, you could have seen that the core business was already quite profitable. If you were looking at cash from operations and then free cash flow, you could see where the company was going. And so before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We're very, very close to reaching 40,000 subscribers. So thank you very much for all the support. At the end of the video, I will cover the highlight numbers for Uber. So if you're interested in that, you can also stay until the end. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so GMV increased 23% year over year to $60.9 billion. Revenue increased 23% year over year to $1.9 billion, which translates into a year over year growth of 29% if we adjust for the sales of the logistics business. Merchant solution revenue increased 20% year over year to $1.4 billion. Subscription solution revenue increased 34% year over year to $511 million. And if we scroll down, we can see that revenue increased faster than cost of revenue, which is always great, which is also why you're seeing gross profit continue to grow quite nicely year over year. Plus, total operating expenses is down year over year, while the company becomes more profitable and can keep on growing. Then, with regards to GPV or gross payment volume, that grew to $36.2 billion, representing 60% of GMV processed in the quarter. Monthly recurring revenue, or MRR, for the quarter increased 32% to $151 million compared to the prior year, driven by continued growth across all subscription plans. Gross profit dollars grew 33% year over year to $957 million compared to the prior year. Gross margin for the quarter, 51.4% compared to 47.5%. So we got margin expansion here year over year. Free cash flow for the quarter, $232 million compared to just $86 million in the same quarter last year. And then free cash flow margin for the quarter, as we've seen before, 12% compared to a free cash flow margin of 6% same quarter last year. Cash and marketable securities were $5.2 billion for the quarter. Then, with regards to outlook. So first of all, they tell us here that year-over-year comparability in their financial outlook will be impacted by the sale of the logistics business, which they expect will create a revenue growth headwind of approximately 300 to 400 basis points and a gross margin tailwind of approximately 200 to 300 basis points when compared to the second quarter of 2023. And so, if we look at the second quarter, revenue to grow at high teens percentage rate year over year, which translates into a year over year growth rate in the low to mid 20s when adjusting for the 300 to 400 basis points impact from the sales of their logistics business, which of course expectations were maybe a bit higher than that. Gross margin for Q2 is expected to decrease by approximately 50 basis points compared to Q1 2024. Gross profit margin, basically the guidance there, missed slightly. And then with regards to free cash flow margin, they expect it to be similar to Q1. They've now delivered 3 consecutive quarters of double-digit free cash flow margin with no expectations for this trend to change. I believe the margin estimates for next quarter were 13%. And so if we look at the graph right now, in the last couple of weeks, it did had quite a nice rebound of the 200-day moving average. Right now, of course, with this earnings report, stock is down under the 200-day moving average, a bit in no man's land right here, $63.45. Yes, previously the stock did linger around those prices back in mid-2023. Could it find a support there? Remains to be seen. Otherwise, maybe look down below. But of course, throughout the day, I think the market might see this as a buying opportunity. And so you might see a small rebound. Also depends on what gets mentioned during the earnings call, but most of the time when it's such a large reaction, it will probably be read throughout the whole day. Then as promised, a quick look at Uber. I'm looking here at the snapshot that Brad Friedman on X provides at Stock Market Nerd. Great account. So the stock is down, by the way, 6% or so. The results: they missed bookings estimates by 0.8%, slightly missed guide by 0.3%, met revenue estimates and monthly active users, beat EBITDA estimates by 4%, and beat guide by 6%, beat free cash flow estimate by 24%. Like I said, plenty of businesses where you do want to focus on free cash flow at first. Sharply missed GAAP EBIT and EPS, including legal charge and equity investment hit, but they did beat EBIT ex legal and beat EPS ex both. As for the guidance for Q2, slightly missed bookings estimate by 0.3%, but met EBITDA estimates. And now if you look at Uber here, I think you could see a good opportunity, a buying opportunity when it gets a bit closer to the 200-day moving average, which sits at around $61.45. Right now, yes, we could have seen that this week it got rejected at the 50-day moving average and was already just under the 20-day one going into this print. And so going back to Shopify here to conclude, good quarter, great company, great management, good execution, growing in a profitable way. It's just that the stock, the company's valuation was just too expensive. Expectations were sky high. And so you get a little correction here. If you can buy shares of a great company at a cheaper price, I think you should do that. I personally do not own Shopify. I love the company. I love what they're doing. But yes, the stock was just extremely expensive. Now maybe a small re-rating. So that will be it for this video. We're going to cover some other companies maybe in the coming hours, in the coming days as well. Tonight, I will be maybe a bit late with regards to Airbnb's earnings report, but I will cover that 100%. Robinhood probably as well. Trade Desk will be for tomorrow or maybe during the weekend. But overall, that's about it. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.